Tesla has released the all-new lower price standard Model Y, and this is now a $40,000 electric vehicle without the $7,500 tax credit. The idea here is that Tesla is really trying to compete in the more low-cost market, and now that these tax credits are gone, Elon Musk has always said that Tesla should have an advantage over competitors. But when we actually look at the options for consumers, it's not really what we see, and the growth is actually not with Tesla. It's with a company called General Motors, but let's dig into exactly what they're offering. My name's Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. If you look at the new Model Y, here is Tesla's ordering page, and you can see that the standard rear-wheel drive vehicle starting at $40,000. You want to get an all-wheel drive, and you're looking at going up to $49,000. Now, I know a lot of people think that Tesla is a pretty accessible vehicle. This is a pretty high price vehicle, and especially when you look at some of the competition. This is the Equinox EV, and you can see that this starts the LT1. This is the Equinox EV, and you can see that the LT1 starts at $35,000. So it's about $5,000 less than a Tesla Model Y. You want to get an all-wheel drive, this goes up a little bit, so now you're looking at more like $41,000. But significantly less. And we're seeing in the growth numbers that these EVs are actually doing really well in the market. This is from GM Authority, and you can see here that the Equinox EV sales grew 156.7% to 25,000 units in the third quarter. Tesla's deliveries, they don't release just US specific numbers, but their deliveries were up 10% for the Model 3 and Model 1. Now, the reason this is key for investors is Tesla is, at the end of the day, an automaker. I know that people have always talked about this being more of a tech company, but their economics are the same as for other automakers. And you can see their operating profit, and this is, if they were a tech company, you would see this operating profit be 20, 30, 40%. Their gross margin would be 70, 80, 90%, but that's not what you have. You have gross margins that are going to be a little bit higher than most automakers, but that's partially because they own the dealership side of the business. But these operating margins are going to be very similar in comparison to most of the other automakers, 6.1% over the past year for Tesla. What do you see at General Motors? Well, they're not quite as volatile, but they're not going down in the same way that Teslas are either. 5.7% operating margin over the past 12 months. And I would expect these margins to maintain about where they are because you don't have the same pressure with the loss of the $7,500 tax credit. That $7,500 is going to come straight out of Tesla's bottom line. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The other thing Tesla is going to have to contend with is their operating margins have been helped by this automotive regulatory credits line item. That was $2.5 billion over the past 12 months. That has been a huge boon for Tesla. At least some of these are going to go away, especially in the US. We saw that Rivian said that basically they're not expecting any credits revenue in the rest of 2025. So we'll see what these numbers look like for the third quarter and then what they expect for the fourth quarter of 2025. But don't expect these credits and their operating profits to be all that much better now that we're in a more competitive environment. In fact, Tesla doesn't even have the lowest cost electric vehicles. So unless people are willing to pay a premium for a Tesla, and it's very possible that they are, I think deliveries are really going to be under pressure. And remember that Tesla's deliveries are already in decline. The peak was actually in 2023 with 1.81 million units sold over the past year. And this is just through the second quarter, just 1.7 million units sold. So these unit sales are in decline, margins are in decline. There's no indication that that's going to change for Tesla, even with a lower cost vehicle. And let's keep in mind too, that new standard Tesla is actually stripping out some of the value that the company had in even some of their lower end vehicles. You don't get the same second row screen. You don't get all the same autonomy and safety features. It doesn't have as many speakers. So it is more of a stripped down model. Now, this is something automakers have been doing forever. So Tesla is just joining the same game that automakers have always been doing. You're going to see the same thing with something like the Equinox EV. If you want all the bells and whistles, you got to pay more. But that's not really the game that Tesla has typically been playing. They've been playing much more of a, hey, we're different. We're going to sell things very differently. It's very interesting that they're going to be in a much more price competitive market, and they're not a leader in the market today. What does that mean for their margins, for the revenue in the future? I think things could continue to go south for Tesla because that $7,500 tax credit was a real benefit for consumers. It was a boon for the company's margins. that's going to be going away, and most other automakers don't have the same headwind to their business. Now, the story has always been that robotaxis or the Optimus robot are going to make up for that. We've seen that robotaxis have been in operation for months now. They're not really expanding in Austin. In fact, we've seen the safety driver move from the right-hand seat to the driver's seat. That is a big change. That is telling us that FSD is nowhere near ready for any sort of wide launch and getting robotaxis into more and more cities. That's as other companies like May Mobility, like Waymo, like even Mobileye scale to more cities all around the world. So operationally, tons of headwinds for Tesla. I don't know that that's going to translate to a lower stock price, but with the stock skyrocketing over the past few months on no real news and no real improvement in operations, I think there could be a downfall ahead, but we'll see, especially with consumers feeling a lot of pressure in 2025. But we'll see what their outlook is for the rest of the year. Let me know what you think about Tesla stock. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.